What's going on, Cashflow hackers? It's Chris with Life 180, and today I am here doing a video review of the white coat investor and his interview with Bigger Pockets, and talking about, is whole life insurance ever a good idea? And he has a pretty hardcore stance against whole life insurance, and it's a pretty, I don't know how to say it. It's a pretty misunderstood stance, in my opinion. I think whole life insurance is one of the most powerful assets in the world. My objective fully in this is just to give straightforward information based on what I know to be true about whole life insurance. Full transparency, I have not watched this video yet. I watched maybe the first 2.5 minutes of it. And I've just decided that I'm going to go through the hour video. I'm going to give my feedback. I might turn this into a 2-part video because maybe it'll get a little bit long depending on how much I do or don't agree with what he says. Based on some of the other content that I've seen the white coat investor do in the past, my guess is it's going to get fairly lengthy. So without further ado, let's get into this a little bit.
Hello, my name is Mindy Jensen, and with me as always is my living co-host, Scott Trench.
Oh, and with me as always is my universally appreciated co-host, Mindy Jensen.
Ooh, that was a good one. Scott and I are here to make financial independence less scary, less just for somebody else, to introduce you to every money story because we truly believe financial freedom is attainable for everyone, no matter when or where you're starting.
That's right. Whether you want to retire early and travel the world, go on to make big-time investments in assets like real estate, start your own business, or not purchase whole life insurance. We'll help you reach your financial goals and get money out of the way so you can launch yourself towards those dreams.
I obviously never read my book.
Gave away the whole show, Scott. Today we're talking with Jim Dolly. We're talking about whole life insurance, and Scott just spoiled it. We're not fans, although there are certain cases when it is a good idea. So we are going to dive into that in just a moment. But before we do that, we're going to go into our money moment. This is a new segment where we bring a money hack, tip, or trick to you to help you on your journey to financial independence. Today's money moment is a really good one that I need to start doing. On your grocery list, include a do not buy section. If you constantly are buying similar things at the store, do a check before you leave the house and write down the things that you already have so you don't buy duplicates.
Love it. Yeah. And as a reminder, we are always looking for guests to come on the show and share their money story or to be coached on our Finance Friday episodes. So if you're interested, go to biggerpockets.com/guest or biggerpockets.com/finance review.
Jim Dolly is emergency room physician and the founder of the White Coat Investor. After multiple run-ins with unscrupulous financial professionals early on in his career, he embarked on his own self-study process to become financially literate. And then he realized nobody else was talking to doctors either. So he decided he was going to create the White Coat Investor so he could help educate doctors with their finances. He is now the CEO, a columnist, and the host of their podcast. Jim, welcome to the Bigger Pockets Money Podcast. I'm so excited to talk to you today.
Thank you, Mindy. It's wonderful to be here with you and Scott.
Let's go over a bit of your career and your history. What
I'm not going to do this.
is your background and where does your journey with money begin?
You know, my background me a lot. Over the years, I realized
I'm going to just try to get somewhere where it's relevant to what we're talking about. I don't need his whole story. If you want to watch the story, there's going to be a link to the video. Go watch it for sure. Okay, I'm going to get to the chapter titled Whole Life Insurance Explained. We're going to start there.
Absolutely.
You know, I think that the prime example of the doctorese of the finance world is going to come in the category of whole life insurance. And that's one of the reasons we wanted to talk to you today in particular, is because I think you have a handle. You are so familiar with this and you have beaten up the case for life insurance, for whole life insurance so thoroughly and so meticulously that we wanted to have you come on and unpack that for us, because I know that a lot of, not just doctors, but a lot of people in general are anxious about that topic. It's something it feels like it's very high stakes. It's sold very hard. Could you give us your overview, the opinion you have on this product? Tell us what it is, how it works, and who should use it, when you should use it, or when you should run away as fast as you can?
Well, let me just from the 30,000 foot view start at the very beginning. I am not against insurance. I am very much a fan of insurance. I think if you are facing a financial catastrophe, you should insure very well against it. And there are financial catastrophes out there. You becoming disabled during your career, especially for a high-income professional like a doc, that's a huge financial catastrophe. You dying while somebody else depends on your income, that's a huge financial catastrophe. Your house burning to the ground, for most of us, that's a financial catastrophe. Becoming ill or injured and ending up in the hospital, running up hundreds of thousands of dollars of bills can be a financial catastrophe. Getting sued, either in your professional life or your personal life, again, a financial catastrophe. I think you should insure, and you should insure well against all of those things. When it comes to life insurance, for the most part, people have a need for life insurance, if they're married or have kids or whatever, that lasts a few decades.
Yeah.
And they should insure very well during those few decades. I'm talking 7 figures of insurance. Most people should carry 7 figures of life insurance. And that's not that expensive if you buy it when you're young and healthy. $600 or $700 a year is all it costs to have $1 million in term life insurance. But what is not a financial catastrophe for most people is dying at age 92. That's just not a financial catastrophe. It's an expected event, right? We all expect that to happen. Presumably, no one is depending on your income when you're 92. So do you need insurance when you're 92? No. And should you buy insurance that you don't need? Generally, no.
So I'm going to stop it right there, and I'm just going to say this. So there's a difference between needing and wanting life insurance. One of the things I talk about with whole life insurance all the time is the fact that it's not a need-based product. It's a financial efficiency product. It's going to help you accomplish the things that you want to accomplish in life, no matter what happens, no matter when it happens. I always say it's a self-completing plan. It's the only way, in fact, to make sure that what you want to happen will happen when you want it to happen, whether you're here to see it or not. And so when you look at it through that lens, listen, things change as you go through life. Maybe you hit 92 and you don't need it so much. But the question is, if you're successful and you've done everything you need to do up until the point you're 92, chances are you're going to have some sort of taxable event from an estate planning perspective. And chances are you're still going to want, at that point in time, it's not about how much do I need, it's how much do I want to give, how much do I want to leave to the next generation. And at the end of the day, the only way to have an optimized legacy plan is by having permanent insurance. What I find to be true is that the people like this guy that don't like whole life insurance typically don't understand the fact that you don't have to sacrifice one for the other. You can have coverage on the front end. And by the way, I'm not a huge purist when it comes to saying just buy whole life insurance. I believe, probably like he believes, that you got to make sure early in your years you have your insurable interest really, really covered to make sure your family's protected. Chances are most of the time that's going to be done predominantly with term insurance, unless your free and clear cash flow is significant enough. But what I bet he doesn't understand, and I can't wait to see what he gets into, is that whole life insurance is infinitely more flexible on the front end, and it's infinitely more liquid than he probably realizes. And so to realize that it can solve different problems at different stages of your life, and I've done a lot of videos on all this different stuff, my guess is he either doesn't understand it, or he's got some agenda for some reason where he just has a problem against this. And not even beyond an agenda, my guess is that he has had bad experiences with agents, and that because of the fact that 95% of whole life insurance policies are sold improperly, he's probably just out there trying to protect people against unscrupulous agents that don't know what they're doing. They don't know how to design them the right way. And so my guess is that's where it started. And then as it kind of evolved, and he probably went down the rabbit hole and learned more, kind of like Dave Ramsey's done. You got to dig your heels in the sand, and you got to have that confirmation bias and shoot down anything that is not in alignment with the story that you've been preaching, because then it discredits everything that you've been talking about and makes you look bad. So obviously that's not a good thing. It's never good to have that kind of level of confirmation bias, but yeah, that's it. So I just wanted to say that whole life is not a need-based product. It's a want-based product. And when you're 92, you may not need it, but I promise you, as you get closer to death, you're going to feel a lot better having it, knowing that you're going to leave the next generation better off versus having term insurance and just moving on to the next life. So let's keep going.
You should not. You should insure well against financial catastrophes, but you don't need to insure your iPhone falling in the toilet, right? You can afford to replace that. And what whole life insurance is a lifelong insurance policy. So whenever you die, whether you die at 25 or 45 or 70 or 92, it is going to pay you. or you pay your heirs, really, pay your estate, but it's going to pay out a death benefit. And of course, if you want something that's going to pay out no matter when you die, that's going to cost a lot more than something that's only going to pay out if you die between age 30 and age 55 or 60 or whenever you become financially independent.
It's actually not a factual statement. In fact, it's so non-factual that I want to take a moment and I want to show you what it can look like. So what I want to do is I want to show this illustration that I think is going to give a good breakdown of where he's wrong on a lot of this. And I'm sure he's going to cover this, but I just created this illustration to just kind of give you a little insight on what it can look like and what a properly designed whole life insurance policy works like and the different problems that it solves. And so I'm going to give you a little breakdown about what it is, and then we can kind of go from there. So when you look at this, you can see here what I did was, because of the fact that I know white coat investor, is talking to more sophisticated, more educated people. Let's call them doctors. And their income is higher, so they should have more in savings. They have a greater need for an emergency fund and stuff of that nature. So what I've done is I've gone through and I've said, all right, let's do 100 grand year one, and let's do 12 grand a year after that. Now, what he would say is that spending $12,000 a year on a whole life policy is flat out stupid. That's what he would say, because of the fact that you could probably get this coverage for maybe $1,000 a year, for all things considered. And so why spend the extra $11,000, maybe $10,500 a year on premium when you can just literally, put money into a term policy and invest the difference? Well, what I always kind of tell people is that there's a major difference between saving and investing. And I think the problem is white coat investor, Dave Ramsey, Susie Orman, all these people have a problem with whole life insurance because they're comparing it and they're saying buy term and invest the difference. Well, they're not talking about your need for savings, your need for safe, liquid, accessible capital that you're going to use for all these different reasons, right? Like whether you want to be a real estate investor, and that's why I wrote my book, Cashflow Hacking, showing people how to use whole life insurance to accelerate the wealth growth and the wealth potential of cash flowing producing assets like real estate. Or maybe you're using it just as your emergency fund, just in case things happen. Ultimately, whole life insurance is wildly flexible, and I'm going to show you exactly what this can look like. And so you can see here with $100,000 year one, what that means is they front loaded the policy with $88,000. My suggestion is anybody that would have that $88,000 in a CD, in bonds, in a savings account, anywhere that you needed it relatively liquid and guaranteed that wouldn't be in a higher risk asset class, that's what you're talking about. This is the money that we need there for our emergency fund and for what I would call an opportunity fund, right? Like, so that $88,000 is starting it. And then there's $12,000 a year in premium. That gets to 88 plus 12 is 100. And you can see here, out of that 100,000, the question is, why would I do this? Well, you're picking up 1.47 million of life insurance, and you got $92,835 of net cash value year one. So that's basically 92.8% of the cash that you put into the policy is completely liquid right there, day one, right? Okay, so year two, you're spending $12,000, right? That's how he would say, why spend $12,000 in a premium when you can only spend less on a term premium? Well, don't think about it as spending money. Think about it as capitalizing a savings alternative, right? Because when you save $12,000 into the policy or spend it on premiums, what's happening is now you have an increase in your net cash value of $13,587. That's how efficient this is. Year two, the policy cash value is growing by more than our premium. You can see here that the way we've got this set up, by year five, right here, by year five, I put in $148,000. I'm going to zoom in just a little bit here. I've got $148,000 of cumulative premium and $151,947 of a net cash value with $1,569,000 of death benefit. Now, when you look at that, remember the death benefit started at $1,478,000 and it's grown during that time. So as the cash value goes up, the death benefit's going to grow a little bit with it as well, which is fantastic. But think about it this way. Look at how this has worked. We are in a situation now where you have more cash value than you've put into the policy. So you are ahead of your term policy. Let's say you're where I am. I basically built this policy around me, saying a 40-year-old that even though I'm 43, I thought myself a couple of years ago, a 40-year-old with 3 kids, needing term policy for the next 15 years and saying, all right, I want to have that coverage in place, but I also believe I need an emergency fund and I want to have an opportunity fund of money that I can use for real estate investing, for business, for stuff of that nature, right? And I want to be able to maybe finance my own cars, and I want to do things of that nature to never interrupt the compound growth of my money. So when we look at it that way, now at year 5, we're already ahead. We've got more cash than we've contributed. If I were to do even $1,000 a month premium or $1,000 a year premium with a term policy, now we're looking, that's a lost expense of $5,000. Now I'm $3,000 ahead. So that's an $8,000 swing. At year 5, I am $8,000 on a net basis in the whole life policy than I would have been with a term policy and saving money in a savings account, right? Remember, I'm not ever going to compare whole life to an investment because it doesn't have the same risk profile as an investment. So we have to think about it in terms of what shares the risk profile, and that is savings accounts, that is CDs, that is bonds, stuff of that nature. And so when we look long-term, whole life insurance is going to give you money market-like liquidity. It's going to give you muni-like tax treatment, and it's going to give you bond-like returns. That's it. And so as we look at this, as we get down to year 10, we put $208,000 into this, and we got $246,000 in net cash value. The death benefit keeps going up. At year 15, in this situation, we paid $268,000 in premium, but we got $364,000 of net cash value. Now, if we had just done the $1,000 a year, 15-year level term premium, that $15,000 would have been burned, right? It's like, he's like, why spend the $268 when you can spend only $15? Well, because if you spend the $15 and you do it the right way, or if you spend the $12 and you do it the right way and you get that $268 total, well, now you've got an extra $100,000 almost sitting in liquid accessible capital. Now, on top of that, you have all the flexibility in the world. You're able to put this money. You could see you have this death benefit that is super efficient, and you could do all sorts of things with your policy at this point in time. You can reduce paid up where you don't have to put any more capital into it. You can use premium offset. You can keep paying the premium, which is honestly the best and most effective and efficient way to go about doing this. And you can see that even after your insurance need ends, you have this. So now you can start from a legacy planning perspective. And I promise you, it's beyond the life insurance. What he fails to talk about, and this is what I feel obligated to get into, is that he just ignores the living benefits of all this. One of the things I can tell you, and I've shared this story a lot, my father-in-law was diagnosed with stage 4 pancreatic cancer at 74 years old, right? Having access to liquid capital and like what a policy like this can do for you, right, is have an accelerated death benefit rider. You access the death benefit while you're alive to pay for terminal diagnosis on illnesses. And so you could do alternative treatments. You're not stuck just doing the chemo and the radiation and things like that. Now, if that's what you want to do, that's on you. That's cool. For us, that was not in alignment with our values. And so we wanted to do that. But guess what? It was multi-6 figures out of pocket to do it. So being able to accelerate a death benefit makes all the difference in the world in your ability to actually have control of your medical directive. People talk about like, oh, do you need life insurance at 92? No, but I promise you, if you have this, you know, what's the amount here that we're going to be having at 92 in this instance, right? Like at 92 here, if you had the $2.3 million death benefit and you could access a portion of that while you're alive, you know, if maybe you're 75 when the premiums end and you get diagnosed with cancer or something, and you have access to $300,000, $400,000, $500,000 cash that you could, you know, manage your medical directive with, and you still are able to leave money to your heirs after that, that's powerful. The reality is, I think he would agree that we're not getting out of this life alive, and that chances are you're going to have some medical issues while you're in retirement. That is just the reality of the world that we live in. And so if that's the case, why is it that he just ignores this element of the insurance? It's not just death insurance. It is living insurance. It gives you access to your money if you become critically, chronically, or terminally ill. You have access to that capital to handle and control your medical directive. And it just pisses me off when I hear people not talking about those benefits. So anyway, now what I'm going to do is I'm going to get back into the video and I'm going to keep watching, and I might go back and forth to this illustration a little bit, but I really felt like I had to share that because he's going to talk about this thing in ways that just are so off base and so uneducated, or so just like leaning to his own confirmation bias. And he's like either ignoring the facts or he's just choosing to not understand the facts because it's not in alignment with his goals and objectives for whatever his messaging is for the people that he's trying to sell whatever he's selling to. So here we go.